Have you ever found yourself pondering over the intricacies of the strangle trading strategy? It's a fascinating topic indeed. Today, we'll delve into this advanced trading mechanism, breaking it down into digestible bits for better understanding. The strangle trading strategy is an options trading tactic that involves buying both a call option and a put option for the same asset. Intriguing, isn't it? The key here is that these options have the same expiration date, but different strike prices. This strategy is a go-to for traders when they anticipate significant price volatility in the underlying asset, but aren't quite sure about the direction of the price movement. Think of the strangle strategy as a wager. The trader is betting that the price of the underlying asset will make a substantial move, either up or down. However, the direction of the movement remains a mystery. Sounds like a thrilling gamble, right? The first step in this strategy is selecting the options. The trader chooses an out-of-the-money call option and an out-of-the-money put option. In simpler terms, the call option strike price is above the current market price, while the put option's strike price is below the market price. And remember, both options must have the same expiration date. The strangle strategy is typically used when a trader anticipates a significant price movement due to upcoming events, earnings announcements, or other market catalysts that may cause volatility. The profit potential for this strategy is unlimited on either side, as long as the price of the underlying asset moves significantly in one direction or the other. But what about losses? Well, the maximum loss is limited to the premiums paid for both the call and put options. The break-even points are the strike prices of the call and put options plus the total premium paid. And what if things don't go as planned? Traders may choose to close out the strangle position if they believe that the anticipated price movement has occurred, or if they want to cut their losses if the price remains stagnant. Alternatively, they may adjust the position by rolling the options to a different expiration date or strike price. However, every strategy comes with its risks. The main risk of a strangle strategy is that the price of the underlying asset does not move significantly within the expiration period. In this case, both the call and put options may expire worthless, resulting in a loss of the premiums paid. In summary, the strangle trading strategy can be a valuable tool for traders seeking to profit from anticipated market volatility while remaining indifferent about the direction of the price movement. However, like any options trading strategy, it demands careful consideration of market conditions, risk management, and the potential for loss. So, the next time you find yourself in a volatile market, why not consider trying out the strangle strategy?